Good afternoon, everyone, and welcome to this Kepler-hosted webinar. Shortly, we'll be hearing from Chris Berrier, who's the new manager of what is still officially known as Jupiter US Smaller Companies, but will be shortly renamed, subject to shareholder approval, Brown Advisory US Smaller Companies. As we discussed in our recent note, which you can find on the site, Chris and his team have generated excellent risk-adjusted returns in the open-ended space. The investment trust structure may perhaps offer some greater flexibility, which will be interesting to see how it may be used over time, including, of course, the ability to take on gearing and run maybe more concentrated portfolios. We think it's very notable that the trust is trading on a wide discount of 8.9%, while the only other North American small cap trust is on a small premium. And the large cap US trusts are also trading much closer to par, which seems interesting to us. So before I hand over to Chris, please note on the right of your screen there is a Q&A box. You'll all be muted during the presentation, and Chris will speak for 25 minutes, half an hour, and then we will put your questions to him at the end. So please write your questions in there, and we will go through those at the end. So with that, I will hand over to Chris.
Great, Thomas. Thank you for that introduction, and thank you everybody for joining us on the webinar today. This is to review the Brown Advisory US Smaller Companies Equity Strategy, which is sort of assuming the underlying management of the Jupiter Trust. Just to bring you up to speed on who we are as a firm, Brown Advisory is an investment partnership that is based in the United States. In Baltimore, Maryland is the principal office, but we have offices in a number of different cities, London, New York, Boston, Washington, D.C., etc. And so it built quite an international, both domestic and international network of investment contacts and liaisons from which to pull from in our investment decision making. And we are a firm that believes deeply in seeking out outside views. The other thing that I think is important about our firm, because it is directly applicable to the underlying management of the strategies, is that we are an investment partnership. 70% of the firm is owned by employees. Every single employee owns equity of some form in the firm. And because of that, we've had the ability to both attract and retain investment talent over a long period of time. So when you look at the next slide, which is our team slide, these people have largely, many of them, been with us for quite some time. I believe the average tenure of our team at the firm is 8 years, and the investment experience runs closer to 15 years. As you can see, there is a breadth of people covering various sectors of the US and, in fact, global economies that help inform our investment views. And we like to refer to the underlying investment team as the foundation of everything that we do. And like any team, the longer you play together or work together, you begin to understand people's strengths, weaknesses, etc. And usually your performance as a group begins to improve over time as you enhance the strengths and you strive to minimize the weaknesses. So it's a long tenured group that I've been working with for quite some time. And the good news is the continuity in the personnel has allowed us to run a philosophy and process that is also one of great continuity and consistency over a long period of time. So why don't we get into philosophy and process in the interest of time on the next slide, and then we'll make sure to leave ample room for your questions at the end. So our investment philosophy is meant to be a North Star. When we came up with this investment philosophy many, many years ago, in 2006, when I began assuming the management of this particular strategy, we asked ourselves, what drives portfolio returns, and what are the inherent characteristics of strong performing portfolios over a long period of time? And it was easy to discover that whether you're looking at a venture capital portfolio, private equity, public markets, it typically is a handful of wonderful businesses held for a long duration that generates above average returns. And so our view was that this power of compounding was extraordinarily robust and should be the bedrock of what we do within this particular portfolio. The story that really drove our interest in the power of compounding and trying to understand it and comprehend it was my old boss, Jack Laporte at T. Rowe Price, many years ago, told me a story of his participation in the Walmart IPO. And at the time, the fund that he managed was about $5-6 billion in total AUM. And he said that he bought the Walmart IPO. He held it for a few years. It got a little bit too expensive. And so he sold out of it. And he said the power of compounding is that if I had just held that original small position in Walmart, it would be greater than the entire size of the fund that I run today. So while this is an outlier example, it truly speaks to the power of long-term compounding and why it is the focus of our strategy. So simplistically put, in a very short-term world, we want to act as long-term business owners and watch companies that we buy when they're relatively small become larger mid-cap, or if we're a little bit lucky, large cap companies over a multi-year period. The other dynamic that happens to take place when you own businesses for a longer duration is that your knowledge of those businesses compounds. So it is true that after 3 years of ownership, you're a little bit smarter on a company than the day you first bought it. And those little nuances about the business, how it trades, how it affects revenues and profits, can come into play to you hopefully maximizing your return stream, or at least understanding where the risks lie. And so I think that this above average knowledge of the positions because of your long-term ownership allows you to better manage risk than someone with a much shorter time horizon. The other element that occurs when you're successful in buying and holding companies for a longer period of time is that as those companies mature and they find an operating rhythm and a niche that they can execute on in their end market opportunity, they tend to have less operational variance in them. They're just better, more soundly run companies. And as the operational risk starts to decline, so does the beta in the business. And so these longer duration holdings that we have tend to help dampen some of the volatility in our return stream, which has led to pretty steady and solid risk-adjusted returns over a long period of time. The final thing that's worth mentioning on this investment philosophy is that one of the cardinal sins of active managers is we tend to sell our winners too soon. And it plagues a number of managers, and I've certainly made the mistake myself. But I think having an investment philosophy like this on paper in front of the entire team has made us better owners of good businesses over the long term. And I think that's certainly aided our underlying investment returns and kept us away from making perhaps the worst mistake of any underlying active manager out there. So with that, that's a little bit on our overall philosophy. Why don't we go to the next slide and just talk about, if you're looking for companies that can compound through time and go from being small to mid to large, what are the attributes that you need to find in order to tilt the odds in your favor? And so we came up with this quote unquote 3G investment filter, which is a checklist for long-term compounders. We're trying to source out of a complicated mix of things, a simplified list of attributes that we want to tackle. And we came up with these 3 buckets. It's durable growth, sound governance, and scalable go-to-market strategies. This is the filter that we lay on top, or underneath, I should say, of our investable universe that helps sort through the businesses that we're going to be interested in and weeds out the businesses that don't necessarily meet the type of criteria that we want to embrace in the portfolio. So growth is important because it's the only way you can compound. And it's not necessarily absolute high levels of growth, it's durable and consistent growth. So we're trying to source companies that have relatively large opportunities compared to the revenue base of a business. And what you really want to find is a company that has a differentiated product service business model such that the slice of a growing pie becomes larger and larger over time. That is the way you enable runway, and that is the way that you enable a multi-year ownership period for a particular investment. It's truly the only way you can go from being a small cap to a large cap. The second, and probably equally important piece, is governance. So when you're dealing with smaller companies, people matter greatly. These companies typically are not the Microsofts and Googles of the world where they have robust systems and processes and multiple layers of management and everything. These are younger companies that are early on in their development phase that need the right hands on them at the right time in their development. Who's going to be your next head of sales? What types of systems and processes are you going to drive into the organization to make it more efficient and scale more effectively? These are critical decisions, and it's upon the management team along with the board of directors that are going to make them. And that's why we spend a lot of time on the governance structure, the incentive system, to make sure that they are in underlying alignment with us as long-term shareholders, where we want to see franchise value maximized over a long period of time, not necessarily short-term fundamental performance or short-term stock price performance. At times, they can be contradictory to one another. So we spend a tremendous amount of time on governance, and that is probably one of the reasons, although we're not an ESG labeled portfolio, our focus on governance over the last 15 years that I've been a part of the strategy is a reason we tend to screen well upon ESG or sustainable criteria and have been used by a number of sustainable investors as a small cap option within their overall portfolio. The final piece would be go to market. And to say that this last G is a bit of a catch-all would be a fair statement. But we tried to think about, what matters when you have high levels of top line growth? Well, what truly matters is that over time, that top line growth is translated down into enviable levels of profitability, substantial free cash flow, and high and or rising returns on invested capital. So the way that a product is configured, packaged, priced, and distributed is critically important into how a company scales and grows. So we're looking for companies that have figured out the right go-to-market motion, that it enables them to capture better and better unit economics as the company gets larger and larger. And what that enables is a better flywheel within the organization, such that if you have a high gross margin and each incremental dollar coming into the company is more valuable, you will have the ability to not only deliver bottom line to your shareholders, but also have enough money left over to reinvest in the R&D and sales and marketing execution that's going to continue to drive leadership in your marketplace, which will enable you to have a longer runway of durable growth. So these are the three buckets that we're looking for when we first come across a business. Our analysts and I spend a lot of time thinking about these when we first encounter a company. And needless to say, when a company scores relatively well in these three areas, we consider it a candidate for the portfolio. But when something doesn't quite fit these characteristics, we likely move it to the side so that we don't waste a lot of time in our overall due diligence efforts, and we really focus our time and attention on things that matter. So let's go to the next slide. This is an overview of our investment process. So when you think about how we conduct our affairs day to day, you have to have a very sound team that understands and knows what everybody is doing and what their priorities are. You have to have an investment philosophy that everyone buys into and is abided by day in and day out. And then you have to have a targeted system or ecosystem of companies that you're focused on, which is informed by our 3G investment filter that I just described. The next piece is building a process that is robust and repeatable and makes common sense. And so when we looked at breaking down the overall investment process, and this stuff is not overly novel, but important, is what matters the most. And it really is idea generation, which is the lifeblood of any good small cap portfolio due to some of the volatility that can exist in the category. It's the due diligence because that's where you're going to drive value-added insights to drive higher returns without necessarily taking on a higher level of risk. And of course, what matters is how do you take all of these individual company bricks and transform them and build them into a portfolio architecture and structure that can withstand the test of time and causes you to be able to drive fairly persistent outperformance in your strategy over a longer period of time. So simplistically, these are the three elements within the process. And I'll highlight not necessarily all the components of these, but maybe what differentiates us slightly from some of our peers. So in idea generation, we do hundreds and hundreds of management interviews every single year. And the reason we do this and spend all this time and effort and have a labor-intensive process is because we think it matters. So when you look at the typical investment manager, usually the answer around idea generation is, well, we build a proprietary quantitative screens that looks at these particular financial traits. It spits out a list of these companies, and then we go attack them. Quant screens are great, and they are useful tools. But the problem with quant screens when you're looking at new ideas is while they tell you a lot about the past, they tell you virtually nothing about what's going to happen in the future. And when you think about stock prices, stocks move on marginal information. So as an investor, what you're trying to do is source positive changes at the margin. What's going on inside the company that's going to make it better tomorrow than it is today? Is it a new product launch? Is it harvesting a number of sales and marketing investments? Is it, essentially better systems that have been embedded? Is it a new CEO that's come in? What is different today that's going to drive positive change in the future? The other area that you can find change is in the ecosystem around the business. So is something changing that's going to make that environment more hospitable for a particular company in the future than today that could lead to success above and beyond what's embedded in the consensus at present? So instead of having a quant screen, although we use them, we really have a long-held process of looking at a universe of a couple thousand companies, sorting through them by market cap and liquidity constraints, dropping that number of 2,000 down to 1,000, and then over time interviewing hundreds and hundreds of companies every single year, such that you begin to really hone in to the types of businesses that fit your 3G investment filter. And so today, because of the long history we've had of operating in this market, we built a fairly large library of knowledge that we can monetize when the opportunity is right. And we're now focused mostly on changes within our underlying ecosystem of businesses or our target market of companies to make sure we stay on top of them to hopefully uncover the next good investment on behalf of our shareholders. So idea generation is the lifeblood of any small cap portfolio. Ours is a labor-intensive process of interviewing hundreds of companies a year, but we think it's the best way to source positive change at the margin. And we think, therefore, it's the best way to find stocks that will hopefully have the ability to A, compound, and B, to do it in a way that has some strong risk-adjusted attributes to the return stream. The next piece is due diligence. Due diligence is something that obviously is covered by many active bottom-up managers like we are. We try to make sure that we focus our due diligence efforts on the things that matter the most. So we go through the motions of certainly reading the Ks and the Qs and the proxy, talking to the management team, talking to competitors and suppliers. But going through those motions is really to drive you to understanding what are the 2 to 3 most important things that matter for the future of this organization. And then we try, once we isolate those, to do as much primary due diligence, whether it's leveraging our own private equity and venture capital investment network, whether it's talking to our firm's long list of private clients that have been either former executives in an industry or current executives in an industry, or simply leveraging investment networks, customer panels, et cetera, to try and understand what are the things that matter the most and are going to drive value. What evidence have we amassed to inform our conclusions about those value drivers? And do our conclusions about them differ from the consensus? And if so, is it positive, negative? And if it's positive, how much more positive? How much money do we think we can make? How much risk do we think is embedded in this if we turn out to be wrong? And from there, we try to take these individual drivers and boil them down into metrics that we can track. So it could be customer churn, number of new customers per quarter, the average contract value of a business, the number of new sales hires, the number of R&D hires. There are various different metrics that float around for different types of companies. And what you're trying to do is isolate those, attaching to a value driver, look at how they trended over time, what's happened to the fundamentals of the business, and then to track those into the future to see, do the metrics support the underlying investment thesis that you've established? To the extent you can answer that question, yes, you should probably own the business and continue to believe you're right. If they start to wobble and the data refute some of the things you laid out in your investment thesis, you probably should think about trimming the business or selling it. And so we think that this metrics-based approach hopefully acts as an early warning signal when things might be going awry within a particular company. And while we are far from perfect, we do believe that having this laser-like focus on fact and data helps us understand and maybe avoid some of the consequences of an investment that goes bad. The final thing that I'll talk about on the investment process is also incredibly important, which is portfolio construction. So we spend most of our time as bottom-up managers looking at the individual investments that we're going to make. Secondarily, what we have to do is when we're making these bottom-up investments, we have to consider any of the unintended top-down consequences that can come from these investments. It's the old don't put all your eggs in one specific basket problem. And so while we are relatively concentrated, and that causes a portfolio to have an attribute of high active share, we know that with that relative concentration and high active share, a premium must be placed on diversification. So we spend a lot of time thinking holistically about how the portfolio is structured, making sure we don't have any unintended top-down consequences, and that we believe we are executing against what really our mission is, which is to provide an all-weather portfolio that can do well in different types of market and economic environments where the returns are driven by the bottom-up stock selection, but the risk is somewhat mitigated with solid downside protection from the structure of the overall portfolio. The final thing I'll say is because of our investment philosophy, one other thing that differentiates us would be the fact that we are long-term oriented shareholders in what can be an exceedingly short-term world within the small cap space. And the reason we think that this is an interesting lens at which to look through is that if everyone's focused myopically on the next quarter, there could be substantial value to be had in just taking a slightly different approach. And so we believe by anchoring ourselves on what could be in 2 to 3 years, not what's going to happen tomorrow or the next quarter, it's going to allow us to effectively understand, the volatility of a stock price better. And instead of being a victim of that volatility in the small cap space, we're hoping to take advantage of that, either to liquidate or trim certain positions that have gone to undue highs, or to acquire businesses at low points where people mistake transient problems for long-term structural issues. And I think only through a long-term orientation and attention to detail quarter in and quarter out can you build a knowledge base that enables you to capitalize on some of the volatility that exists. So if we go to the next slide, what we just went through was most of the process elements related to the strategy. This is just a quick snapshot of portfolio construction, which hopefully enables us to have a slightly deeper conversation on portfolio returns later. So our typical holdings today, we're close to the 80 mark. Our top 10 is going to be about 20 to 40% of the portfolio. It's about 25 to 30% today. The high active share has been in the low 90s for quite a long period of time. We have conviction weightings in the portfolio such that we look at long-term return or opportunity streams relative to the risk we see in the price should something go wrong. We focus on being prudently and holistically diversified. So it's not just mapping to what a benchmark says. This is really thinking about, long cycle, short cycle, very expensive stocks, cheap stocks, cyclical stocks, non-cyclical stocks, et cetera, et cetera, et cetera, to try and make sure that you're building something that is diverse as possible such that you can withstand various different types of market climates. The other factor, because of our investment philosophy and the investment filter that we use, is the portfolio assets tend to be of higher quality in general than the overall benchmarks that we're compared against. And so if you take together a robust process that's focused on risk, if you combine that with high asset quality, you combine that with diversification, and you also have a fairly disciplined valuation construct that you try to think through when you go through each stock. It's not just buying momentum securities. It's thinking about what the true worth is and why. All of those underlying elements are what drive the downside protection in the strategy, which has been prevalent for a very long period of time. And so again, we're trying to drive upside and returns through bottom-up individual stock selection, but it's fundamentally this portfolio construction dynamic that we have, attention to quality, diversification, and valuation, that has helped mitigate some of the downside risk. And on the right-hand part of this page, you can see the classifications of the portfolio sectors by GICS and ICB. And the only thing worth noting here is that they're different. And that difference is meant to state that these classification engines are not perfect. They get it wrong a lot. Our underlying classifications that we do internally are bespoke because we want to try to get it as right as possible. So I think if I spoke to the fact today that our technology weight is a little bit underweight the benchmark, the GICS classification methodology would not speak to that. Whereas you could look at maybe the ICB and there are flaws in their methodology in other ways. And so this is only brought up to the extent that if you go on and do some more work, and you look at these sector classification systems, they do not necessarily speak the truth. And there's another layer of due diligence and probably parsing out of our holdings that's necessary to really understand how we're allocated. But the most important thing to probably talk about would be, there are four main components of the strategy. They all tend to oscillate around 20% in weighting: technology, consumer broadly defined, industrials, and healthcare. They move as economies move, as market structures move, and all of these other smaller segments and a couple percentage points in cash will reflect the balance of the other 20% of the portfolio. That's probably the best rule of thumb to have in mind in terms of the overall classification methodology. So why don't we go to the next slide? This is really the final component. Most people spend a lot of their time on the types of companies you buy. Why do you buy them? Why do you get excited? How do they get into the portfolio? What type of valuation metrics do you use when you buy in? And that occupies a lot of time. And it's important because, one of the main drivers of portfolio value is obviously finding these wonderful businesses and holding on to them for the long term, which is why we have that philosophy of guarding against the cardinal sin of selling your winners too soon. Well, this slide, sell discipline, is all about, the second great cardinal sin of active managers, which is holding on to your losers too long. So whether it's through our own data analysis or using external third parties, keeping a trade diary, et cetera, we've tried to become better sellers of stock over time. And what we have learned and have incorporated is that, our guts from the data we see are relatively good on selling, but some of the historical data says you should be more aggressive. And so when we think about being aggressive and having the conviction to do that, most of our sell discipline is really focused on violations of our investment thesis. So we use a scorecard every single quarter, anytime a significant event happens in our companies, that shows the investment thesis, it shows a bunch of the key takeaways, shows the value drivers, and keeps track of all the core information and metrics that are most pertinent to the investment. And so what we've done here is built something that keeps everybody on the same page, is consistent across all of the companies that we look at. And we can see on this page, if it was a little bigger, you could see it more clearly, what the key metrics are, how they've moved around quarter in and quarter out, and we can compare them to our investment thesis. And when they start wobbling the wrong way, we have to ask questions. And if we don't get sufficient answers to those questions, it's probably a clear sign that we need to start working the position down or perhaps sell it outright. The final thing that these sheets allow us to do is when we exit an investment, whether it's good or bad, we conduct an after action review. We look at when we got in, when we got out, the sizing, the decisions we made along the journey of that particular investment, and we look for flaws in our methodology or thinking. And to the extent that we can find patterns in these flaws over time, then we can course correct, hopefully build things into the process to make us a little bit robust and stronger. And hopefully that helps drive better performance over a extended period of time. So just in the way that our philosophy hopefully anchors us to holding the best businesses, this sell discipline on this page and in the scorecards that we use and the after action review methodology hopefully enables us to continuously become better sellers of stocks. And if we can become a little bit better at holding our winners and a little bit better at liquidating our losers faster, while it might not show up in any one quarter in a big way, over the long term, you will amalgamate more and more basis points in your favor. And over a long period of time compounding, that makes a meaningful underlying difference to clients. Next page, please. So if you look over the long track record of the strategy, this is showing the Brown Advisor US Smaller Companies representative account. This strategy goes back even longer than this. I started managing the strategy in the second quarter, I believe it was April of 2006, so just coming up on 15 years. Over the 15 years, the philosophy and process have been consistent, and there's been a hallmark of the strategy where our returns are once again driven by individual stock selection. 80% of our attribution over 15 years is through individual bottom-up stock selection. And we've done a reasonably good job in portfolio construction mitigating some of the downside. If you think about particular periods of time that are favorable for us or unfavorable for us, we've done pretty well in down markets, sideways markets, choppy up, trending up markets. We've had a harder time in periods where if it's micro cap, lower quality, risk on rallies in the market, due to our emphasis on quality and valuation, et cetera, we've tended to lag in those periods of time unless there's some element of really, really strong individual stock performance for us. So those are the periods where we tend to underperform. Most of the other periods, it's going to be stock selection dependent, but those periods of underperformance tend to be truncated and over a more extended period of time, it tends to blur out in the underlying performance comparison. I'll touch upon one or two more things quickly in the next couple slides and then open it up for Q&A. So on the next slide is just our top 10 holdings. It's an eclectic group. It's represented by names that are both mature and have been in the portfolio 7, 8, 9 years. It also has companies in there that have been in for a much shorter period of time, like a Zynga or Workiva. And the point of showing you the top 10 is that we typically try to offset the higher growth names in the portfolio, earlier stage like a Workiva, with things like a Waste Connections or a Charles River that might have a little bit more ballast and history to them. And that's something that's embedded in the top 10 and certainly something that's embedded in the entire construction of the portfolio overall. The final couple slides, and then I'll open it up, is, we pursue the activities that have been outlined in what we think is an advantage universe of companies. So the US has a large and deep market of small caps. It's a highly innovative economy. Things are constantly changing, and that provides opportunities for us to pick off interesting investments, hopefully before they become broadly recognized. The other inefficiency that we tend to think about is the fact that, sell side coverage of these businesses is much less the more down the cap spectrum you go. And that tends to lead to better opportunities for us to uncover angles of attack on a particular investment where we think we can generate outsized returns without necessarily generating excess levels of risk. The final piece would be on the next slide, a development that's more recent, but also fairly profound, which is you can see here that over time, the percent of passive capital in small caps has grown immensely. And while I wouldn't have conceded that years ago it had a meaningful impact, today it certainly has a somewhat meaningful impact to the day-to-day, week-to-week returns of the market. And we do believe that as the percentage of passive capital has marched itself toward 50%, that it will start to create, and probably already has created, mispricings in the market that can be arbitraged, whether it's too low or in fact prices that are too high. And so while this is a systematic thing that may last for quite some time, it has also created this universe that we live in of relatively consistent upward bias returns, punctuated by periods of excess volatility and downward movements in the market. And our hope through the entire process that we have is that we can be prepared for volatility when it comes, and hopefully take the appropriate actions for the benefit of our shareholders to monetize the volatility when it comes. So with that, I think we covered a lot. I'll pause and open it up for Q&A in the remaining 10 minutes or so that we have.
Thanks very much, Chris, for a very good run through portfolio. We've had quite a few questions coming in, so thank you for that. Please do keep them coming in. We'll try and get through as many as we can. So there have been a couple of questions surrounding the turnover in the portfolio. Could you give us an idea of what your average holding period is typically, and how your turnover tends to look and change over time?
Sure. Good question. The holding period that we envision for an investment is many, many years at the start. Sometimes we get lucky and things happen faster than we think, and we make more money in a shorter period of time. And sometimes we're unlucky or wrong and have to realize that and move on from an investment. But we do have a mindset toward owning things for a long period of time. And in fact, when we originally look at an investment, we are weighing our 3-year view, quite heavily. And so that is our typical target. And the reason I bring that up is because our underlying turnover over a very long period of time has been in the low 30% range, which roughly corresponds to that anchoring around a 3-year view of a business. What I would tell you is that in periods of excess volatility, when the opportunity set changes a lot in terms of relative value, our turnover may move up and could get as high as 40, maybe even 45%. And in periods where volatility is low, you may see that overall turnover rate move down into the 20% range. And in fact, that's what we have seen over the last several years here. So I think the right range to think about is low 30% turnover, and that corresponds roughly to how we think about our investment time horizon when we initially get into a business.
And in terms of the transition of the portfolio you're inheriting, someone has asked how long you expect that to take, and then we've also had a couple of questions around whether you've looked at the portfolio and there are some companies that you would like to hold on to, or if you're simply going to wholesale start afresh.
The transition period has already occurred. It took us roughly 7 days to transition virtually the entire portfolio. There were a few names that were overlapping between the old portfolio and our portfolio, but it seemed impractical of us to hold names that we either A, didn't have a lot of conviction in, or B, had no knowledge in. So we wanted to make sure that we affected that transition to what is our best thinking as fast as humanly possible. So that process started at the beginning of the month. It took us, again, the better part of 2 trading weeks to get it all done. We were very pleased with the underlying execution that we got, both in terms of cost and certainly price. And so right now, the portfolio does reflect essentially our model portfolio. And while we're on this topic, I'm sure we're going to get a question around how might the trust differ than maybe other strategies that we manage. And while we don't think it's going to differ materially, there's certainly an opportunity in the trust to perhaps take advantage of a little bit more idiosyncrasy in terms of position size, perhaps slightly bigger positions in some cases, or a shorter list of names. And I say this is at the margin, not huge amounts of variation. And then there's also the benefit of being able to use gearing, which we think will be episodic. There are typical time periods where both our micro assessment and the macro environment makes it highly conducive to using leverage, where we take our cash position historically down, and we honestly wish we could deploy more capital into some of our holdings. So that has happened a few times here over the past, call it 5 to 6 years. And so we think that the primary difference between the trust and the traditional accounts that we've managed will likely be a little bit of delta in position size, and certainly the usage of gearing selectively and opportunistically through time. But I doubt leverage will be a underlying mainstay in the portfolio and a consistent thing that's held through, because we certainly know it can cut both ways.
And on that issue of leverage, maybe is your attitude to leverage significant when it comes to selecting stocks, and is that part of the reason why you've done relatively well on the downside relative to the market?
I would say that generally, we feel very good about the composition of our balance sheets relative to the indices that we're typically compared to. We run much lower leverage across the portfolio, always have. Yes, we will have a handful of positions out of 80 that might have some appreciable level of leverage, call it 2, 3, maybe even pushing 3.5 to 4 turns. But that is a minority of the portfolio. And typically when we see companies have leverage rates that are that high, they're high because of some event. There was a once in a lifetime opportunity to buy a competitor, to consolidate market power, and then to pay down that leverage over time due to robust and visible cash flows. So yes, the balance sheets tend to be much cleaner, and I do believe that balance sheet health has certainly been a piece of the quality dynamic that's helped some of the downside capture statistics of the portfolio.
And maybe we could tie together a couple of questions on valuation. So in a broad sense, how do you think about the valuation of when you're selecting stocks, and how important is it? And then when it comes to the more speculative end of your universe, more speculative growth stocks, at what point would they become uninvestable for you? Where do you draw the line?
The latter part of that question is obviously hard to define because each company is unique. So it's hard to judge, when is something too speculative. I think speculation when you see it. And so, yes, there's a line in the sand of, how risky we will go. To give you some order of magnitude, we probably have a slightly better fit to the Russell 2000 growth benchmark than the Russell 2000 because of our bias toward compounding durable growth businesses. Because that is the case, we are compared against an index in the R2G that has 45 to 50% of the businesses in it making no money at all. When you look at our percent composition of money-losing companies, it's in the low double digit. And honestly, that is an all-time high only because we've had a unique set of opportunities that have popped up in the IPO market where we've added a couple businesses that are in fact, quite mundane in nature. These are not sort of speculative entities with, no revenue attached to them. They're real revenue businesses, some of them quite substantial, but they're investing heavily for growth and they're losing a little bit of money today. And so that ratio of our sort of low double digit weighting in unprofitable businesses compared to the 45 to 50% weighting, that gap gives you a sense of, what is our speculative appetite perhaps relative to the broader landscape of companies overall. And this does help inform, the valuation tactics and methodology that we use because, just because you can't calculate a PE doesn't mean something isn't an interesting investment. It very well might be that at this point in the life cycle, the right thing to do is to invest as much as humanly possible in sales and marketing, as long as the efficiency of that spend is good, such that you solidify your leadership position and you take enough share and you've got enough customer mind share and wallet, importantly, to build a referenceable base that you can then trade off of over time. So valuation is an art. It's not a science. I don't use rules like anything above a 20 PE is too high or anything below a 10 PE is too low. That's a value stock. We try to look at the uniqueness of the business and then think about the art of crafting a valuation framework and a range for the company. And it really is a three-legged stool. It's looking at absolute and comparative multiples over time. It's looking at a discounted cash flow analysis with some scenarios built into it. And it's looking at past precedent transactions, whether in the public market or the private market. And that's why it's an art, it's not a science. There's no one holy grail for valuation. You use what's available to you, use what's most appropriate for the company at a given stage of its life. But at the end of the day, we are ardent believers that every company is worth the value of their discounted cash flows. The art, when you get into growth companies or earlier stage companies, is how far out are those cash flows? And how prodigious are those cash flows? And if you believe that they're going to come faster and be bigger than everyone expects, that losing money company might be a great investment. If you believe it's going to take longer and the profits are going to be smaller, that might be a catastrophically terrible investment for you to make. And so we just do our best to triangulate value using the tools that are available to us. We're a big believer in, looking at a bunch of different scenario analyses. And we try to just look at probability-based decision making to see if something looks like it is more beneficial to our shareholders to include it in the portfolio or more beneficial to exclude because of the valuation or price. So price matters. Valuation is very important to everything we do, but we're not rules-based valuation people. We try and understand the uniqueness of each company and then try to value it accordingly.
And so in terms of the valuation of your portfolio at the moment, are you comfortable with it? And perhaps we could tie that together with looking at the current market environment. So clearly since perhaps September last year, or certainly since the results from vaccine trials, there's been a bit of a rebound in value versus growth in small caps as well as large caps. How long lasting do you think this sort of this move is likely to be?
Yeah, that's certainly the $64 million question. I'll try to answer this in absolute terms, in relative terms, and then give you 2 cents on an outlook, or maybe it's not an outlook, but things that I think about. On a relative basis, we feel pretty darn good about our portfolio compared to the benchmarks. We just believe that the quality of the assets we own relative to and the growth rates that we own on a comparative basis and the sustainability and predictability of the earnings stream feels superior to us. We could be wrong there, but we're pretty darn comfortable in the relative merits and think it is an attribute that would help investors in a bad market, not hurt them. On an absolute sense, when looking at the portfolio, the composition of it changes year in and year out, not dramatically, but enough that the comparisons are a little bit different. I would say that given the rise in the market, it is certainly true that at an absolute level, our portfolio today is at the margin a bit more expensive than it might have been several years ago. But so is every other asset on planet Earth, from houses to bonds to you name it. So we try to underwrite things on an absolute basis. We keep one eye on absolute and one eye on relative as we manage the portfolio. And we acknowledge that we're trending sort of toward there's a band, we're closer to the high end of the range on absolute levels when we look at the portfolio compared to history. But then when we look at the band and look at where we're trading vis-a-vis where the index is trading, we start to feel pretty darn good about the value therein. There has been a change recently of the leadership and complexion of the market, and it's led to maybe 2 similar risks that manifest themselves slightly differently. So when we look at the growth space, growth companies did disproportionately well during the pandemic because of principally the work from home dynamic, which favored technology companies, and the fact that the pandemic was a healthcare problem and healthcare companies were viewed as part of the solution. So the fact that growth is overweight tech and healthcare was a very, very good thing, and it drove outperformance. Not to mention that those businesses happen to be much more sensitive to changes in discount rates. And when global central banks, took their policy and made it as loose as humanly possible, that had a disproportionate benefit to the long duration assets that are housed in the growth area. The catalyst for value doing better in the fourth quarter and so far on a year-to-date basis within the small cap space is just that we're going from lockdown, which disproportionately crushed value companies, to reopening, which, if you look at the earnings trajectory, disproportionately benefits value businesses. It also is the case that these inflation data that we see and the corresponding rise in interest rates is a much more favorable thing because of the content within the small cap value segment of the market than growth. So higher rates better spread business at banks. Banks are a higher proportion of the value space, so that's good for them. Also, inflation rising, most sensitivity there, energy, materials, industrials. So you want to find companies that can benefit and pass that through. So there's just more content there. The risk is about the same, which is inflation and rates rising. But it's really two different reasons. So when we look at growth, certainly some of the cooling off, and it's still a great year-to-date return. So it's nothing to sneeze at. The problem growth might have is pockets of elevated valuation, very low discount rates, and will inflation cause the 10-year Treasury to go from 1.25 to 1.5 and not stop, but to go from 1.5 to 1.75 or 2? And if that happens, I think that is going to raise the discount rates that's used on some of the growth businesses and make it more difficult for the valuations to hold or certainly expand on a go-forward basis. So I think that's the biggest risk to the growth sleeve in the short run. In the intermediate to longer term, I still think growth is where the economic future is. The prospects are going to be better for those businesses. And so on any longer term framework, I'm still a believer in growth relative to value, but certainly the construct of rising rates might be more acute for growth companies. Value has a different problem. Value's problem is that they need economic growth in order to thrive, particularly in terms of earnings growth. And what you had in the pandemic was a decimation of the earnings growth in certain categories. And what you're seeing now is a robust return to growth coming off a very, very low level within value. And so what you're going to have a couple quarters from now, instead of incredibly easy comparisons, are incredibly difficult comparisons. And at the same time, if you do not have incredibly robust fiscal stimulus come through that perpetuates the velocity of the recovery, it's going to be very difficult to comp the comp that we're currently seeing. With the added issue of tax rates. So the last time that small value companies went crazy to the upside, Donald Trump was elected president. And the corporate tax cut program he put in place was a huge catalyst for small value. Today, in the United States, we're looking at the exact opposite. We're looking at policy prescriptions that are basically raising taxes across the board, both on corporations and to an extent, certain individuals. So if that happens at the same time that economic momentum starts to slow, then you're going to have a situation where the EPS of the smaller value cohort is going to be challenged. So I would say that in the immediate term, growth has some challenges. In the intermediate to longer term, value has some challenges. So I think the $64 million question is, what happens to inflation? What happens to rates? And that's going to tell you much of the picture as to who wins the battle between growth and value over the next couple quarters.
Brilliant. Thanks, Chris. I think you've answered 2 or 3 other questions that I was going to try and sneak in there. So that was great. I'm conscious that we've run over time by quite a considerable amount. So thanks very much for staying on and answering those questions. There were 1 or 2 that we didn't quite manage to get, but I would point out that if you're looking for information on the reduction in the management fee, then that is on our note, and there's also some information about the discount there. So thanks very much, Chris, for taking your time to talk to us today, and thank you to the audience for listening.
Yeah, cheers. Thank you, everyone, for part of your day. Appreciate it. Have a good one. Stay safe.
Goodbye.